Listen to me, because this is the money lesson you cannot afford to skip. You have worked your entire life. You've put in the years, you've dealt with the bosses, and you've watched those FICA taxes come out of every single paycheck since you were a teenager. You were told that Social Security was your safety net, your reward for a lifetime of hard work. But now that you're standing on the doorstep of retirement, or maybe you're already there, you're realizing there is a silent partner waiting to take a cut of that check. And that partner is the IRS. It makes you angry, doesn't it? It should. The idea that you are taxed on money that was already taxed when you earned it feels fundamentally wrong. It creates this pit of fear in your stomach. You're asking yourself, how am I supposed to budget if I don't even know how much of my own money I'm allowed to keep? You're worried that those taxes are going to eat away at your quality of life, meaning you can't travel, you can't help the grandkids, or worse, you might run out of money. But we don't live in fear, we live in power. And power comes from knowing the truth of the numbers. Here is the bottom line: yes, you probably have to pay taxes on your Social Security, but it's not based on your total income alone. It's based on a very specific, almost secret number called your provisional income. The IRS calculates this by taking your adjusted gross income, adding back any tax-exempt interest, like what you get from municipal bonds, and then adding exactly 50% of your Social Security benefits. That total sum is what determines your fate. If you are filing as an individual and that provisional income is between $25,000 and $34,000, you are going to pay income tax on up to 50% of your benefits. If you earn more than $34,000 as an individual, up to 85% of your benefits could be taxable. For those of you who are married filing jointly, the stakes change. If your combined provisional income is between $32,000 and $44,000, you're looking at that 50% mark. Anything over $44,000? Now you're looking at paying taxes on up to 85% of your Social Security. Now, I want you to hear me clearly, this does not mean the tax rate is 85%. It means that 85 cents of every dollar you receive from the Social Security Administration is added to your taxable income and taxed at your ordinary marginal rate. If you are in the 12% or 22% bracket, that is what you pay on that portion of your benefits. Why does this happen? Because these income thresholds haven't been adjusted for inflation since 1984. Think about that. In 1984, $25,000 bought a lot more than it does today. Back then, only about 10% of retirees paid these taxes. Today, it's closer to half of you. It's a stealth tax that catches people off guard because they assume Social Security is free money. It isn't. So, what do? Do you just sit there and let the IRS take it? No. You take action. First, you need to look at your tax bucket strategy. If you are pulling money out of a traditional IRA or 401k, every dollar you take out increases your adjusted gross income, which pushes your provisional income higher, which then triggers more tax on your Social Security. It's a vicious cycle. This is why I have told you for years that the Roth IRA is your best friend in retirement. Money taken out of a Roth is tax-free and, this is the golden nugget, it does not count toward your provisional income. If you can lean more on tax-free sources and less on taxable ones, you can actually keep your income high enough to live on while keeping it low enough to stay under those IRS thresholds. Second, you must decide how you want to pay. You can choose to have federal taxes withheld from your Social Security checks by filing a Form W-4V. I highly recommend this if you don't want a nasty surprise and a big bill come April 15th. Being forced to save for your taxes throughout the year is much easier than trying to find $5,000 or $10,000 in a lump sum when you're on a fixed income. And don't forget your state. While the federal government is taking their piece, 41 states and the District of Columbia currently do not tax Social Security. But if you live in places like Colorado, Connecticut, or Rhode Island, your state might want to cut too. You need to know the rules of where you live. I want you to stop being afraid of the taxman and start being a master of your own math. You cannot control what the government does with tax law, but you can control how you withdraw your money, which accounts you use, and how you prepare for the bill. Retirement is supposed to be your time of freedom. Don't let a lack of knowledge turn it into a time of financial stress. Check your numbers, talk to a tax professional if your situation is complex, and always keep more of what you earned.